Ladies and gentlemen, Asian guy here. I want you to pause for a second and think back to yesterday, back to Christmas morning. Think back to the moment I flipped on this camera, crashed your holiday dinner, and warned you that the market was broken. I told you the calm was fake. I told you liquidity had vanished. I told you we were standing in a room full of gasoline just waiting for someone to strike a match. And most importantly, I told you that when the markets opened on December 26th, the price wasn't going to creep higher. I told you it was going to teleport. Well, look at the screen. Look at what just happened, $75.14. That was the high of the day. We closed around $74.50. We gapped up almost $4 in a single shortened holiday session. This wasn't a rally. This wasn't a trend. This was a market dislocation. We didn't just break the all-time high, we vaporized it. We left it behind like it never mattered. There are traders in London who went to lunch with silver at $72 and came back to find their entire short book wiped out at $75. We warned you. We told you Ghost Week wasn't a time to nap, it was a time to survive. And today, the survivors are the ones holding physical metal. The casualties are the ones holding paper shorts. I want to break down exactly how this move happened today because it confirms everything we've been talking about for the last month. Usually when an asset moves 5% in a day, it climbs in waves, buyer, seller, buyer, seller. It grinds its way higher. But today was different. I was watching the level 2 data at the open. At 830 AMA, buy order hit the system. It wasn't even that big, maybe 500 contracts. In a normal market, that's a 10-cent nudge. But because it was Ghost Week, because the senior risk managers at JP Morgan are in Aspen, and the order book was empty, that order hit a vacuum. There were no sellers at $72.50. No sellers at $73. No sellers at $73.50. The matching engine had to scan all the way up to $74 just to find the first willing seller. And bang, the price teleported. It skipped the cents and moved in dollars. This is what we call an air pocket. We've entered a zone where the laws of gravity don't apply because there's no atmosphere of liquidity to slow the move down. And the scary part, the buying wasn't even aggressive. This wasn't a squeeze yet. This was just a few hedge funds getting positioned for January. If a little bit of buying can teleport the price to $75, what happens on January 2nd when the real buying starts? Today's move validates 3 specific things we've been shouting about. First, the blue sky theory. We told you that above $71 there is no resistance. Technical analysts love drawing lines on charts. They love to claim resistance at $72.50. But today proved those lines were make-believe. Once we cleared the old high, there were no bag holders waiting to sell. Everyone who owns silver is in profit, so why sell? The sellers went on strike, and when sellers go on strike, the price goes vertical. Second, the hard floor. Remember the Asahi vault drain. 1.4 million ounces gone. That created a floor. We saw a few attempts to push the price down today. At 10 o'clock a.m., there was a quick dip to $73.80. It lasted 3 minutes. The arbitrage bot seeing Shanghai trading at $83, which we'll get into in part 2, stepped in and bought that dip instantly. You cannot crash a market that has no inventory. Third, the algo panic. We told you the robots would switch sides. For 10 years, the algorithms were trained to short rallies. Today, we watched the flip. The moment $73 broke, momentum algos turned green. They started chasing the move. They didn't care about fundamental value. They saw a new high and hit buy. This is the algorithm of God we talked about, and now it's working for us. I also find it fascinating that the financial media is silent tonight. CNBC is talking about tech stocks. Bloomberg is talking about oil. Nobody wants to talk about silver. Why? Because they don't have an explanation. They can't explain why a dead rock just printed a new all-time high on a holiday. They can't explain why the dollar is sliding while rates are high. They can't explain why China is paying $83. They're quiet because they're terrified. They realize they missed the boat. They realize they told clients to avoid precious metals, and now those clients are going to fire them. This silence is bullish. When the media starts screaming, buy silver, that's when we worry. But right now, they're in denial, and denial is the first stage of a supercycle. But here's the most important takeaway from today. This was day 1. Ghost Week runs until January 2nd. We've got 4 more trading days in this skeleton crew environment, and today we proved the skeleton crew can't handle the pressure. They couldn't hold $72. They couldn't hold $73. They couldn't hold $74. What happens on Monday? What happens when traders in London wake up and realize they're short at $71 while the price is $75? They're going to panic cover. And what happens if we get another headline out of Venezuela? We are entering the acceleration phase. The move from $20 to $30 took months. The move from $70 to $75 took hours. The move from $75 to $80 could take minutes. Now I need to talk about psychology for a moment. I know some of you are staring at your account balance tonight with a smile. You made a lot of money today, and the temptation is to smash the sell button. The temptation is to say, wow, $75. That's incredible. I'll take my profit and buy it back lower. Don't do it. That's the retail trap. Retail sells the breakout. Institutions buy the breakout. If you sell at $75, you're giving up your position at the exact moment acceleration is kicking in. You're selling your ticket to the moon just because the rocket shook a little on liftoff. Do you think BY is selling at $75? Do you think the Chinese solar companies are selling? No, they're buying more because they know what I know. $75 is cheap. In a world where Shanghai is paying $83, $75 is a discount. In a world where the Fed is cutting rates into inflation, $75 is a gift. And speaking of Shanghai, we need to talk about the spread. You might think that because silver popped $3 today, the gap with China closed. You might think arbitrage is doing its job. You're wrong. While we were celebrating $75, Shanghai moved the goalposts. We've got new data from the overnight session in China, and the price they're trading at right now makes $75 look like a joke. And if you think $75 is the ceiling, you're reading the wrong map. You're looking at a local distortion in New York, while the real market, the physical market that actually consumes this metal, has already moved to an entirely different zip code. While we were popping champagne over a $4 move here in the States, the Shanghai Futures Exchange was open for its overnight session. And what happened there makes our rally look like a rounding error. Fresh numbers are coming out of China right now and they're staggering. The front-month silver contract in Shanghai just hit a high of 18656 UNN per kilogram. Let that sink in, 18656. If we pull out the calculator, convert at the current exchange rate of roughly 7 to the dollar, and then divide by the 32.15 ounces in a kilo, we're not looking at $75 anymore. We're looking at $83. $83. Do the math with me. The U.S. market closed at $74.50. The Chinese market is trading at $83. That's an $8.50 premium. Yesterday, we were screaming about a $9 gap when prices were lower. Today, New York jumped $4, and the gap still didn't close. It just shifted higher. China looked at our rally, laughed, and bid it up even further. That's the definition of a broken market. In a functioning global economy, arbitrage is supposed to be instant. If an asset is $8 cheaper in New York than it is in Shanghai, every bank, every hedge fund, every algorithm on the planet should be buying New York and selling Shanghai until those prices meet in the middle. That's how efficient markets are supposed to work. It's free money. It's the closest thing to a risk-free trade. But the gap isn't closing. It's sticking around. It's getting wider. And that tells us something disturbing about the state of the global supply chain. It tells us the arbitrage mechanism, the glue that holds the global financial system together, has snapped. It tells us the banks can't move the metal. They can trade paper contracts in New York all day long. They can shuffle digits on a screen. But they physically cannot source the 1,000-ounce bars, put them on a plane, and deliver them into a warehouse in Shanghai to capture that $8 profit. The logistics have broken, the inventory is gone, we are watching the separation of the paper price and the physical price in real time. That $83 print in China is the ghost of Christmas future for the American market. It's showing us exactly where this is headed. New York is the lagging indicator, Shanghai is the leading indicator. China is the buyer of last resort, and right now they are panic buying, and you have to understand this isn't speculation over there. This isn't some retail trader on Reddit trying to squeeze a short. This is industrial survival. The entities bidding silver up to $83 are solar panel manufacturers in Yongsu. They're battery factories in Shenzhen. They're the industrial core of the world's second largest economy, and they're scared. They're looking at their inventory for 2026. They're looking at flatlining mine supply, and they're realizing that if they don't lock in metal now at any price, their assembly lines stop. An industrial buyer is price inelastic, meaning they don't care if the price goes higher. If you're building a $50 000 electric vehicle and it needs $80 worth of silver, you pay the $80. If silver goes to $100, you pay the $100. It's $20 more on the car rounding error for the final product, but it's existential for the production process. You cannot build the car without it. So when you see Shanghai trading at $83, you're seeing the real floor of the market. That's the price where physical demand is actually clearing. Anything below that is just a paper illusion, and it creates a massive, irresistible magnet for the New York price. Think about the liquidity vacuum we talked about. We're in Ghost Week. Volume is thin, sellers are scarce, and hanging over the market is this giant $8 arbitrage incentive. Every algorithm that's still running sees it. The high-frequency bots, the ARB bots, they're all staring at that spread. Their code is screaming, buy New York, sell Shanghai. Even if they can't physically ship the metal, the buying pressure in New York still kicks in like a sympathetic reflex. The New York price has to climb toward the Shanghai price, because eventually, if the spread gets wide enough, someone will find the metal to move. Someone will drain the last remaining ounce from the COMEX and fly it to China. That's why today's rally was so violent, and it's why this move is only getting started. We're playing catch-up. New York is scrambling to close the gap. But every time we rally, China rallies harder. It becomes a feedback loop. China bids higher to secure inventory. The spread widens. New York rallies to chase the spread. That rally validates the higher level, and China panic buys even more. It's a death spiral for the shorts and a rocket ship for the bulls. Now let's talk about who's caught on the wrong side of this $83 reality. The bullion banks in London and New York are short. They sold paper promises. They sold contracts at $68, $70, $72. Now the screen says $75, and the real price is $83. They're underwater on billions in notional exposure, and normally their playbook would be to tamp the price down, dump a wave of paper shorts, crush sentiment, trigger a sell-off. But they can't do that right now. Why? Because if they smash the paper price in New York down to $70 while China is at $83, they turn the arbitrage spread into $13. They make the incentive to drain the COMEX even stronger. If they push the price lower artificially, they're basically paying people to come take their physical inventory away. So they're trapped. They can't suppress the price without bleeding physical reserves, and they can't let the price rise without getting crushed on their short book. They're checkmated. The only way out is to let the price rise, capitulate, and try to flip long before the rest of the world catches on. That's why I keep saying the $100 wave is unstoppable. It's not just hype, it's basic math. The equilibrium price has to be higher than the $83 currently trading in China, because China is still net short metal. They're still importing. If the market was truly balanced, the flow would slow down. Instead, it's accelerating. We're seeing data that imports into China via Hong Kong are spiking again. They're sucking the world dry of silver, and you also have to look at the currency piece of this Shanghai price. The yuan is weakening slightly against the dollar, yes, but not nearly enough to explain this gap. This is a pure metal repricing. This is the East saying, we don't trust your paper derivatives, we want the rock. And they're putting a premium on immediate delivery. That's the key phrase, immediate delivery. The Shanghai price is for metal. The New York price is for a promise of metal later. The spread between those two prices is the risk premium for the Western financial system cracking. The market is pricing in a default. It's pricing in the chance that if you buy a COMEX contract, you might not get your silver. That risk is worth $8 an ounce right now. Next week, it could be $10. So when you look at that $75 print on your screen, don't think, wow, it's expensive. Think of it as trading at a 10% discount to reality. You're getting a Black Friday deal on a strategic asset that's running out. The market is giving you a window, a brief moment where paper games haven't fully caught up to physical desperation. But that window is closing fast. What we saw today, the teleportation, was the market lurching toward parity. It was step one. We've still got $8 more just to hit par with China. And do you really think China is going to stand still? No. The moment New York hits $80, China will be at $90. That's how a super squeeze works. It's a race to the top. And in a race like this, the only losing move is to sit on the sidelines, or worse, bet against it. Ghost week and thin liquidity are acting like an accelerant. It's like pouring gasoline on a fire that was already out of control. With no sellers in New York to absorb the buying, the price has to jump in these huge increments just to find liquidity. And the magnet pulling it higher is that massive, glowing neon sign in Shanghai that says, we pay $83. Every trader sees it. Every algorithm sees it. And starting Monday, when more desks come back online, every institutional capital manager is going to see it too. They're going to realize they missed the first leg. They're going to see the discrepancy, and they're going to panic in FOMO. Fear of missing out is strong in retail, but it's even stronger in institutional money when they're underallocated to the best performing asset class of the year. They have to chase. They don't have a choice. So the $83 target isn't a prediction for next year. It's a reality right now in the dominant physical market. And it's a target for next week in the paper market. We're watching the convergence, and the violence of that convergence is exactly what we saw today. But if you think that was wild, wait until we talk about the catalyst that actually lit the match this morning. Because it wasn't just math. It wasn't just arbitrage. There was a specific event, a kinetic event involving the United States military that flipped the algorithms from buy to panic buy. The geopolitical temperature didn't just rise, it boiled over. While we were focused on the price, the U.S. Coast Guard was escalating a situation in the Caribbean that has global superpowers on high alert. This is the kinetic spark I warned you about. The math is the fuel, but war is the fire. And what happened off the coast of Venezuela this morning is exactly the kind of headline that sends safe haven assets vertical. It shifts the calculus from profit to protection. And when capital starts moving for protection, price targets stop mattering. You need to understand the details of this incident because it's the primary driver behind the algorithm behavior right now. It's why the dollar is getting dumped and silver is getting hoarded. This isn't just about supply chains anymore. It's about sovereignty. It's about a blockade sliding toward a shootout. And silver, the ultimate war metal, the ultimate non-sovereign store of value, starts to look like the only place left to hide. So let's dig into the specific incident involving the tanker Centuries, because the mainstream media is skating past it. But the shipping registers and the naval intelligence chatter are painting a picture of a conflict that's spiraling. This is the match that lit the fuse on the $75 rocket, and it's still burning. Math gives you the fuel, but you still need a match. You need a trigger that forces algorithms to stop running spreadsheets and start panicking about survival. And this morning at 4:30 a.m. Eastern, that match got struck. While you were sleeping, the United States military didn't just escalate the trade war, they pushed it into a shooting war, or at least a boarding war. We've been warning for weeks that Venezuela was the black swan, nobody was watching. We said the sanctions were morphing into a blockade. And today we got the confirmation that sent the safe haven algos into overdrive. I want to be very specific about what happened because mainstream financial news is burying this under holiday fluff about retail sales and Santa Claus rallies. Early this morning, U.S. Coast Guard Special Operations teams, supported by naval assets, forcibly boarded a crude oil tanker named the Centuries in international waters off the coast of Venezuela. This wasn't a paperwork check. This wasn't a polite request for a manifest. This was a kinetic operation. We have reports of personnel rappelling from helicopters onto the deck. We have reports of the crew being detained. Now, why does this matter? The Centuries isn't just some random boat in the Caribbean. It's a Panama flag vessel, yes, but it's owned by a Hong Kong-based shipping conglomerate. It was carrying 1.8 million barrels of crude bound for China. Do you understand what that means? The United States just seized Chinese-owned property in international waters. This isn't a sanction. This is an act of war. This is a direct physical challenge to China's energy security and its sovereignty. For months, the White House has used the word embargo. But actions speak louder than words. When you rappel onto a ship and seize its cargo, that's a blockade. And the response from the East was immediate. Beijing issued a statement condemning the action as piracy and a violation of sovereignty. Moscow warned that this cowboy behavior threatens global shipping lanes. But the most important response didn't come from a diplomat or a press secretary, it came from the market. You have to understand how the modern financial system actually works. The high-frequency trading algorithms that run the futures market scan headlines in microseconds. They don't read full articles. They hunt for keywords. They measure sentiment. So, when the news wires flashed, U.S. Coast Guard boards tanker China condemns and blockade in the same instant, the algorithms flipped from risk-on to war mode. And in war mode, the logic is brutally simple. Sell the currency of the aggressor, sell the debt of the aggressor, buy the asset with no counterparty risk. That asset is silver. Usually gold is the primary safe haven. And yes, gold rallied today too. But silver outperformed. Why? Because silver is strategic. In a blockade scenario, supply chains snap. If ships stop moving, commodities stop moving. Gold is money, but silver is money, plus industry, plus war tech. It's used in Tomahawk missiles. It's used in the guidance systems of the helicopters that boarded the ship. It's used in the satellites tracking the fleet. The market realized today that a blockade in the Caribbean doesn't just slow oil, it threatens everything. It freezes the global logistics network. And remember the logistics breakdown we talked about earlier. The market is already terrified it can't move silver from London to Shanghai. Now, you've got U.S. Naval Forces boarding ships. Who is going to ensure, guarantee, or even feel comfortable moving a cargo of silver across the Atlantic right now? The risk premium on moving physical metal just exploded. That's why the spread between paper and physical blew out. That's why the algorithms panic bought the COMEX futures, because they know the physical metal is effectively getting locked down. If the U.S. dollar is being weaponized to seize ships, then the U.S. dollar is no longer a safe place for China to store its wealth. If you're China and you just watched your ship get seized, do you buy more U.S. treasuries? Do you keep reserves in a currency that can be turned off or used to fund the Navy seizing your oil? No. You dump them and you buy metal. This incident confirms the acceleration of de-dollarization, which is the ultimate long-term driver for silver prices. And here's the scary part. This incident with the Centuries isn't the end. It's the beginning. We're climbing the escalation ladder. We have reports of a Russian naval detachment moving toward the Caribbean for joint exercises with Venezuela. What happens next week? What happens if a Russian destroyer positions itself between a U.S. Coast Guard cutter, and a Venezuelan tanker. Every rung up that escalation ladder pushes silver higher. Step 1 was sanctions, and we saw silver at $30. Step 2 is a blockade, and we're seeing silver at $75. Step 3 is kinetic conflict, and that's where you get triple digits. The market is already pricing in Step 3. Smart money isn't waiting for the shooting to start. They're positioning now. And that brings us right back to the Ghost Week factor. This headline hit the tape on December 26th, the most illiquid day of the year. If it had landed on a normal Tuesday, there would have been sellers to absorb the shock. Commercial hedgers would have sold into the rally. But today the sellers were gone. So when the war algos fired their buy orders, they slammed into a vacuum. That's why we got the air pocket. That's why we teleported to $75. Geopolitical fear collided with a liquidity void, and the result was a vertical repricing. The banks were helpless. Their algorithms are built to manage risk. And when the risk parameter effectively goes to infinity because you've got a geopolitical clash between superpowers, the algorithm pulls liquidity. It yanks the offers, it steps back, and lets the price run. This is exactly what we warned about. The skeleton crew on the bank desks didn't have the authority to stand in front of a war-driven rally. They just watched it happen. Now, look deeper at what this tanker seizure means for insurance markets. It's a boring detail that retail tends to miss, but institutions obsess over it. When a state actor seizes a commercial vessel, war risk insurance premiums for shipping in that region spike. That raises the cost of transporting everything oil, grain, and yes, metals. It adds friction to global trade. It makes physical arbitrage even more expensive. If it suddenly costs 20% more to ship silver from London to Shanghai because of war risk insurance, then the London-Shanghai arbitrage gap has to widen by another 20% just to compensate. That confirms the $8 spread we're seeing isn't just a temporary glitch. It's the new cost of doing business in a fractured world. The global village is burning down, and in its place we're getting a fragmented map of blockades and seizures. In that world, the only thing that matters is what you can hold in your hand inside your own borders. Paper promises from a bank in New York mean nothing if the ship carrying the metal can get boarded by the Coast Guard. So yes, the kinetic spark lit the fuse. And the explosion in price we saw today was money fleeing the system of trust and moving into the system of reality. The U.S. government broke the trust by seizing the ship. The market answered by seizing the silver. And that creates a feedback loop that doesn't end until the geopolitical tension cools off. And if you look at the map, if you listen to the rhetoric coming out of Washington and Beijing, that tension isn't easing. It's getting worse. But there's another force at work here, one that has nothing to do with war and everything to do with physics. We need to talk about what happens when an asset breaks its all-time high inside a vacuum. We need to talk about the structural mechanics of the chart itself. Because once you clear the last line of defense, once you break the final resistance level that has pinned price down for decades, you enter a strange, violent environment. Technically speaking, silver is now in blue sky. And in blue sky, the rules of gravity change. There's no resistance. There's no history overhead. There are no sellers trying to get their money back because everyone is in profit. When you combine a kinetic geopolitical trigger with a technical breakout into all-time highs, you don't get a market that simply trends, you get a market that accelerates. It starts moving exponentially. It creates a vacuum of its own. The higher it goes, the more buyers it attracts and the fewer sellers are left. It turns into a singularity. And mathematically, it's actually easier for silver to go from $75 to $100 than it was to go from $70 to $75. We're entering the zone of zero drag, and war isn't the only driver here. While geopolitical sparks are flying in the Caribbean, there's a quieter, colder, and honestly more powerful force working on the chart itself. It has nothing to do with politics and everything to do with market structure physics. We need to talk about the technical reality of what happens when an asset breaks its historical ceiling and enters the vacuum of space. We need to talk about the physics of blue sky, because silver just did something it hasn't done in 45 years. It broke out of the massive consolidation pattern that defined 2 generations. By closing above 7,450 and tagging 7,514 today, silver has officially entered price discovery. And you'll hear analysts throw that phrase around, but I want to explain what it actually means for the algorithms that control 80% of the volume. In a normal market, price movement is a fight. It's trench warfare. As price climbs, it runs into resistance. And resistance isn't just a line on a chart, it's a memory of pain. Resistance is where people bought in the past and got trapped. If you bought silver at $50 in 2011, you spent the next 14 years staring at a loss. You were a bag holder. So when price finally comes back to $50, your psychological instinct is to sell. You want your money back, you want the pain to end, and that urge to sell creates resistance. It acts like gravity pulling price back down. But look at the chart today. Look at $75. Who's trapped at $75? Nobody. Who's waiting to sell at $76 just to break even? Nobody. There are no bag holders. There's no memory of pain. Every single person, entity, or central bank that has ever bought an ounce of silver is sitting on a profit right now. And when everyone is winning, nobody wants to leave the table. That's what we call a seller's strike. The natural supply that usually comes from frustrated investors simply disappears. Why would you sell an asset that just broke its all-time high and is sliding into a parabolic phase? You wouldn't. You hold. And when holders refuse to sell while aggressive buyers driven by war headlines step in, the supply curve goes vertical. You get an environment of zero drag. It's mathematically easier for silver to run from $75 to $100 than it was to go from $70 to $75. The friction is gone. The atmosphere is gone. We're in a vacuum. And in a vacuum, a feather falls as fast as a hammer. In this case, price rises like a rocket because there's no air resistance to slow it down. Now let's talk about how high-frequency trading algorithms process this blue sky data. For the last decade, these bots were built around mean reversion. The logic was simple: if price is high, short it because it will come back to the average. They made billions fading rallies. But today, around 9:00 a.m., those algorithms went through a regime change. When an asset breaks a multi-decade high, the model flips from mean reversion to momentum trend following. The logic changes. Instead of short the high, it becomes buy high, sell higher. The robot doesn't care about value. It doesn't care that silver looks historically expensive in nominal terms. It only cares about the vector. It sees the angle of ascent, calculates the lack of resistance, and it piles in. That's why we saw the price teleport today. We saw moves where price jumped 50 cents in a single tick. That happens because the algorithm scans the order book for sellers and finds emptiness, so it has to bid higher and higher just to locate liquidity. And it creates what we call steps. Price doesn't curve up, it stair steps: $75, $77, $80. Each step becomes a new floor because there's no overhead supply to knock it back down. And on top of that, we're seeing the early stages of a gamma squeeze in the options market, which turbocharges this blue sky physics. Market makers, the banks selling options to speculators, are short gamma. That means they sold call options at strikes like $75 and $80. As price rips through those strike levels, the market makers start bleeding. And to hedge that risk, they're contractually and mathematically forced to buy futures. Think about that loop. Price jumps on war news. Market makers sell options. Price pushes higher into blue sky. Market makers panic and buy futures to hedge. That hedging pushes price even higher, which forces them to buy even more futures. It's a forced feedback loop that feeds on itself. And in a blue sky environment, there's no ceiling to stop it. In 2011, there was a ceiling because the market still had that historical reference point, the Hunt brothers high from 1,980. Today, there isn't. The only real limit is the currency itself breaking down. And let's be honest about the currency. Blue sky for silver is basically a black hole for the dollar. When we say silver is heading to $100, what we're really saying is the dollar is losing the ability to buy strategic assets. Silver isn't changing. The denominator is collapsing. The algorithm knows it. The AI trading bots running sovereign-level money are starting to correlate silver not with other commodities, but with Bitcoin and other debasement hedges. That correlation shift matters. If silver starts trading like a crypto-style scarcity asset driven by scarcity and network effect instead of normal industrial supply and demand, then the valuation models break. In a crypto-style mania, a 5 times or 10 times move is normal. And if silver captures even 10% of that digital gold premium, then $100 becomes a conservative base case, not a moonshot. So technically, the setup we have right now is one of the most explosive chart patterns you'll ever see. It's a grand supercycle breakout paired with a supply shock inside a liquidity vacuum. You honestly couldn't design a more bullish scenario. If you asked an AI to sketch a chart that trends toward infinity, it would draw the silver chart exactly as it looks right now, the 26th of December, 2025. But there's danger here, and I need to be responsible. In blue sky, volatility cuts both ways. You can get air pockets to the downside, too. If a massive seller, say a central bank trying to smack the price, dumps $1 billion of paper into the market, price could drop $5 in a minute because the bid side is thin as well. These are the widowmaker wicks. They're built to liquidate over-leveraged retail traders. That's why we warned you about leverage. In blue sky, the ride is vertical, but it's violent. The elevator cable is cut, and the rocket boosters are on. You do not want to be holding a 20 times leveraged position when the rocket shakes. You want to be holding physical metal or unleveraged equity, sitting back and letting the market's physics do the work. And remember what we saw today, this gap to $75 was achieved by the B-team junior traders and automated bots. The real captains of capital, the people who control trillions in pensions and endowments, aren't even at their desks yet. They're seeing these alerts on their phones while they're out on the ski slopes. They're watching silver print all-time highs and they're feeling FOMO. They're realizing they're underweight the best performing asset of the decade. And that leads to the terrifying question, if the market can teleport $4 on the buying power of a few algorithms and junior traders, what happens when the boss level players return? What happens on January 2nd when the biggest asset managers and the sovereign wealth funds turn their terminals back on and decide they need to allocate 1% of their portfolio to silver? 1% of global managed assets is more money than the total value of all the silver ever mined in human history. If they try to enter this market in a vacuum with these physics, price won't just step up, it will gap. $10, $20 at a time. That's what an institutional panic looks like in a market that's the size of a thimble compared to the ocean of liquidity they're bringing. The skeleton crew lit the fuse today. They proved the resistance is gone. They proved the selling pressure is basically zero. But they didn't bring the real capital. The real capital is sitting on the sidelines watching, waiting, and getting more anxious by the hour. When they come back, they're going to pour gasoline on this fire. And that's exactly what we need to prepare for on January 2nd. The boss level is unlocking. The volatility we saw today was the tutorial. The real game is about to begin. But as violent as today was, and as exciting as it is to see $75 on the screen, I need to give you a serious warning. What we witnessed today was the light version of the squeeze. It was the demo. It was the dress rehearsal done by the understudies. The real show, the main event, the boss level of this entire supercycle hasn't even started yet. You have to understand who was trading today. The desks in Manhattan and London were staffed by junior associates, the skeleton crew. Their job is simple: keep the lights on, don't blow up the bank, and run the basic algorithmic maintenance. They don't have authority to deploy billions in capital. They don't have authority to shift strategic allocations. They're just reacting to headlines. And even with only the B team playing, they still teleported the price by $4 and smashed the all-time high. So ask yourself the scariest question in finance right now. What happens when the A team comes back? What happens on Friday, January 2nd, when the holidays are over and the managing directors, the CIOs, and the heads of global macro strategy return to their desks? These are the people who control the real money, sovereign wealth funds, pension giants, the biggest pools of capital on earth. We're talking about entities like the sovereign wealth funds of Norway and Saudi Arabia. We're talking about the biggest pension funds. We're talking about the mega asset managers. We're talking about tens of trillions of dollars that's been sitting on the sidelines. Right now, as I'm speaking, these captains of capital are in chalets in Aspen or on yachts in Street. Bart's checking their Bloomberg terminals on an iPad, and what they're seeing is making them sick. They're watching silver and asset. They have basically zero allocation to rip to all-time highs. They're watching a kinetic conflict flare in the Caribbean. They're watching the U.S. dollar index roll over. And they're realizing they're underweight, the one asset class that actually matters right now. In the institutional world, being underweight, a top-performing asset isn't just unfortunate, it's a career-ending mistake. If silver runs to $100 and they have no exposure, they lose clients, they lose bonuses, they lose jobs, that creates a psychological force stronger than greed career risk. So when they walk into the office on the morning of January 2nd, their first meeting won't be a casual catch-up. It will be an emergency risk committee. The agenda will be simple. We're naked on inflation. We're naked on war risk. We need a hedge. Get me silver. And here's the problem. It's a physics and volume problem. The silver market is microscopic. It's a thimble. The institutional capital that wants in is an ocean. The entire available physical silver market is worth maybe a few $1 billion on a good day. A single big pension fund can deploy more than that into one tech stock on a random Tuesday afternoon. If a massive pension system decides to move even 0.5% of its portfolio into silver to hedge inflation, that single allocation can be larger than the entire daily liquidity of the COMEX. It's like trying to force the water of the Hoover Dam through a garden hose. The hose doesn't handle it. The hose bursts. The price doesn't just rise, it dislocates. That's why I call January 2nd the boss level. Because the buying pressure won't be coming from fast-twitch algorithms scalping 50 cents. It'll be coming from slow-moving institutional whales trying to accumulate millions of ounces no matter the price. They're price inelastic. If a giant asset manager decides it needs physical silver for an ETF, it doesn't care whether it pays $75 or $85 or $95. It needs the ounces to back the paper. And remember the unobtainium concept we talked about. When these whales enter, they consume all the oxygen. They clear the order book instantly. If you think today's air pocket was wild, wait until you see an order for 5,000 contracts hit the market at the open on January 2nd. We could see price gap from $75 to $85 in the pre-market session before retail even wakes up. This is the institutional FOMO wave. And historically, this is the wave that creates the parabolic blow-off top. In 1980, it wasn't only the Hunt brothers, it was the world waking up to the fact that the dollar was dying. In 2011, it was hedge funds front-running QE2. In 2026, it's the entire global financial system realizing the bond market is broken, the stock market is a bubble, and the only safe harbor is the one asset they don't own. And the tragedy for the retail investor for you is that people usually sell right before this wave hits. You see the profit on your screen today. You see $75. You think I'm a genius. I made a killing, and you sell. You hand your silver to the institutions. You become their liquidity. You sell your ounces at $75, then you watch in disbelief as they ride those same ounces to $200. Don't be the liquidity for the institutions. Don't sell your lifeboat ticket just as the Titanic starts to tilt. The institutions are desperate. They're late to the party. They're frantic. Make them pay up. Make them pay the blue sky premium. If they wanted your silver, they should have bought it at $20 like we did. Now that they want it at $75, the price is not for sale. And we also have to factor in the January effect. In finance, January is when new mandates kick in. It's when portfolios rebalance. It's when fresh capital gets deployed. If the strategic narrative for 2026 shifts toward a commodity supercycle or a war economy, and looking at the headlines, how could it not? Then the flows into commodities in the first week of January will be torrential. Silver is the smallest, the most volatile, and the most explosive commodity in the whole complex. It's the sports car of the sector. When money flows into the commodity bucket, silver moves 10 times faster than copper or oil. It has the highest beta. So even the January rebalancing flows alone without the war panic could push us to $80. Add the war panic, add a short squeeze, add empty vaults, and you've got the recipe for a vertical melt-up. Now visualize the opening bell on January 2nd. The floor traders in New York, what's left of them, and the algorithmic desks in Chicago will be staring at a backlog of market on open buy orders that piled up over the holiday weekend. They'll look at inventory reports showing zero deliverable metal. They'll look at Shanghai trading at $85 or $90 by then, and they'll have one thought lift the offer. There won't be any serious attempt to suppress. The banks aren't stupid. They know when the dam breaks. Their goal on January 2nd won't be to fight the trend, it'll be to flip long and ride it. They'll join the stampede. And when the manipulators become speculators, the price target basically becomes infinity. That's why I keep saying Ghost Week was only the fuse. The real explosion happens when volume comes back. Today mattered because it exposed how fragile the system really is. It proved a small push could knock over the dominoes. But next week, we're not getting a push, we're getting a bulldozer. We're also hearing rumors, and I'm cautious with rumors, but this source has been right before a major U.S. The tech company is preparing to announce a strategic silver stockpile for its hardware division in the first quarter of 2026. If that drops in January, in the middle of this chaos, it's a checkmate move. It validates the industrial shortage thesis instantly. It becomes the Tesla buys Bitcoin moment for silver. So the roadmap is simple. Survive the volatility over the next few days. Hold through the Widowmaker wicks. Ignore the noise. And wait for the cavalry to arrive on January 2nd. But they're not coming to rescue the shorts, they're coming to wipe them out. The boss level isn't a difficulty spike for us. It's a difficulty spike for the banks. It's the moment their decades of suppression finally get overwhelmed by the sheer weight of global capital looking for safety. The wave is building. You can see it on the horizon. It's a $100 wave moving at the speed of war. The only question left is this: are you going to stand on the shore and watch it, or are you going to ride it? Because once this wave crests, the financial landscape changes forever. The dollar won't buy what it used to, and silver will never be cheap again. In the final part of this report, I want to lay out specific price targets for the next leg. We need to recalibrate. The old targets are dead. $70 is history. We need to talk about $85, $100, and the numbers that sound insane right up until they print. I want to give you a roadmap for the endgame so you know when to hold, when to fold, and how to handle the psychological warfare of triple-digit silver. The $100 wave is unstoppable, but you need a surfboard. Let's build one. So, if $75 was just the warm-up and $83 is the current reality in Shanghai, where are we actually headed? We need to throw away the old maps. The targets that sounded bullish 6 months ago, $50, $60, are now ancient history. We're in a new paradigm and we have to recalibrate what 2026 really looks like. I'm officially raising my target based on the speed of this breakout, the collapse of the arbitrage mechanism, and the arrival of sovereign-level buyers in a time of war. $100 is no longer a moonshot. It's the conservative base case for the first quarter of 2026. I want you to really sit with that number, triple digits. It sounds impossible to a mind that's been trained by 40 years of suppression, but look at the math. In 1980, silver hit $50 when global money supply was a fraction of what it is today. If you adjust that 1,980 high for real inflation using 1,980 CPI metrics, not the watered-down government numbers we use now, silver should already be trading at $400 just to match its old purchasing power. So, at $100, silver isn't expensive. It's barely catching up to decades of currency debasement. It's simply repricing to reflect the fact that the dollar has lost 98% of its value. The bubble isn't in silver. The bubble is in the currency you're measuring it with. But here's the danger for you, the retail investor. The biggest risk right now isn't a price crash. The biggest risk is psychology. You're going to feel enormous pressure to sell in the coming weeks. When price hits $85, your brain is going to scream. You'll look at your portfolio and see gains you've never seen before. You'll think I should cash out. I should lock this in. I should buy a new car. That's the retail trap. That's the exact moment the wealth transfer happens, not from poor to rich, but from impatient to strategic. If you sell your silver at $85, what are you getting back dollars? You're trading a scarce strategic war-critical asset for a paper liability being printed into oblivion to fund the very war pushing the asset higher. You're selling your seat on the lifeboat to buy a ticket back onto the Titanic because the buffet looks good. Don't do it. Don't trade the real for the fake. The only time you should ever sell your silver is when you're swapping it for another hard asset, land, a business, a home. Never trade it back into fiat unless you have an immediate expense you must cover. And you need to prepare for volatility. The road to $100 won't be a straight line. It will be a violent, nauseating roller coaster. We'll see days where price drops $5 in an hour because a bank tries to trigger a liquidation cascade. Those are the Widowmaker wicks I warned you about. If you're leveraged, they'll kill you. If you're holding physical metal or unleveraged equity, they're gifts. Here's your strategy for the next 10 days. First, ignore paper price drops. If you wake up next Tuesday and see spot silver down $4, don't panic. Go to an online dealer. Check the price of a physical eagle or maple leaf. I guarantee the physical price won't have dropped. Premiums will expand to fill the gap. If paper dips while physical stays firm, buy the paper dip. It's a temporary dislocation. 2. Watch the gold to silver ratio. This is your real compass. Don't stare at the dollar price. Look at how many ounces of silver it takes to buy 1 ounce of gold. Right now the ratio is compressing, but silver is still historically cheap. In 1980 the ratio hit 15 to 1. In 2011 it hit 30 to 1. Until we see that ratio drop below 30, the silver bull market is still young. We have huge room to run relative to gold. 3. The unobtainium phase. Understand we're getting close to a point where you may not be able to buy silver at any price. As industrial panic accelerates, we expect major refiners to declare force majeure or impose allocation limits. That means they stop selling to retail dealers so they can prioritize industrial clients like Samsung and Tesla. When that happens, the buy button disappears from your favorite bullion site. The price on the screen becomes meaningless because there is no inventory. If you're still sitting in cash waiting for a pullback, you're playing a dangerous game. You might be waiting for a dip that happens in a market that has already closed its doors. We are entering the boss level on January 2nd. Institutions are coming. War risk is rising. Vaults are empty. The price is unchained. You already did the hard part. You bought when nobody wanted it. You held when it was boring. You survived the suppression. Now you just have to do the hardest thing of all, sit on your hands. Don't let them shake you out. Don't let them steal your position. You're holding the only asset that matters in a world that's losing its mind. The $100 wave is coming. It's unstoppable. And for the first time, the wind is at our backs. I am John A.G. Ghost Week is ending. The real game is beginning. Remember to like, subscribe, and share. See you on the other side.